Chapter 10, the cost approach to value, depreciation. Depreciation is the loss in value from all causes of property having limited economic life. The loss in value may come from wear and tear or the presence of features that are deficient, excessive, or simply currently undesirable. There also may be external factors causing the loss in value. Total depreciation is from all causes from the time of construction to the effective date of the appraisal. Accountants, appraisers, and economists often share this terminology. The term accrued depreciation, which has appeared in previous IAAO texts, originally came from the accounting profession. Accountants define the term as the total depreciation taken on an asset from the time of purchase to the present. Accrued depreciation is normally deducted from the asset's value to derive book value, also referred to as net book value. Depreciation in appraisal terms is an economic phenomenon applied to the total sum invested in improvements. It is not the same as accountants' book depreciation, the prescribed systematic write-off of the cost of an asset over time. Depreciation in appraising is market-related and has no relationship to the asset's original cost or book depreciation. Although the term accrued depreciation has been used in the past, the more correct and current term for appraisers of property is depreciation. In three approaches to value, only the cost approach can measure each individual form of depreciation. In the other two approaches, sales comparison and income, depreciation is a lump sum number representing the total of all three forms: physical deterioration, functional obsolescence, and external or economic obsolescence. Depreciation, which is measured separately only in the cost approach, is the difference between cost new of property and its market value as of the date of appraisal. Thus, depreciation is subtracted from the cost new as of the date of appraisal. The depreciated cost of the improvement can be considered as an indication of the improvement's contribution to the property's market value. The most difficult part of estimating value by the cost approach is accurately estimating the depreciation. The older the structure, the more likely it is to have deteriorated, and often in ways not easily observable. Therefore, the appraiser calculating the depreciation should be highly skilled in its estimation. Depreciation also may be described as a loss in value from any cause except depletion. Depletion is the loss of value due to consumption and is properly applied to oil, gas, precious metals, and timber. In fact, it is possible that a property may appreciate rather than depreciate, which is the case when abnormal scarcity exacts a market premium. Depreciation is estimated as follows: cost new of improvement less the contributory value of improvement, the market value, which equals the depreciation. The cost new is equal to the replacement, reproduction, original, or trended reproduction cost. Depreciation is directly related to utility. New construction is designed to maximize utility. However, changes in the demand for space, new technology, and space-related costs, such as heating or cooling, can cause loss in utility, which is interpreted and applied by the appraiser as depreciation. Confidence in the cost approach requires a depreciation estimate supported by market data. The appraiser must determine how the loss of utility affects market prices, because the objective of real estate appraisal is to discover market value. Depreciation can be measured either directly or indirectly. It is measured indirectly from an analysis of similar properties or directly from an analysis of the subject property in the cost approach. Both direct and indirect methods of measuring depreciation are acceptable and should, in theory, result in the same value or approximately the same value as long as the appraiser applies this method in a consistent and logical manner. Whatever measurement method the appraiser uses, he or she must first evaluate how the structure may experience each type of depreciation. All categories of depreciation represent reductions in total utility of the structure in the eyes of a knowledgeable buyer. It is less important to worry about precisely classifying a condition for which a depreciation charge should be made than it is to recognize the condition and make an appropriate deduction. A particular item of depreciation could fit within two different categories, and more than one form of depreciation may be present in the same improvement. Various methods of depreciation can be used in combination to solve specific problems, or each method can be used separately to test the depreciation estimates derived from the other methods. The origins and causes of depreciation fall into the following three general categories of diminished utility: physical deterioration, functional obsolescence, and external economic obsolescence. Total depreciation is the summation of these three types of diminished utility. Depreciation can generally be considered either curable or incurable. Whether an item is curable or not reflects a direct application of the principle of contribution, that the value of an agent in production or property component depends on its contribution to the whole. Curable depreciation, which is economically prudent to correct, succinctly demonstrates the appraisal principle of contribution, since the cost to cure must be justified by an increased value or utility at least equal to the cost to cure. On the contrary, incurable depreciation is not economically justified to correct, because the cost to cure is greater than the value added by curing the depreciation. As improvements age, they may suffer physical deterioration and functional and external obsolescence. As a result, they lose value relative to newer structures because potential buyers perceive that older improvements have diminished utility. Demand decreases, and sale prices for properties with older improvements fall below those of properties with new improvements. In summary, the true measure of depreciation is the effect on marketability and sale prices. Appraisers estimate depreciation loss in value by estimating the amount of value loss incurred by the subject property in its present condition, as compared with the value of the property as if it were new. By estimating the depreciation incurred by an improvement and deducting this estimate from the improvement's cost new, an appraiser can determine the depreciated cost of the improvement. The depreciated cost of the improvement approximates its contribution to the market value of the improvement. Causes of depreciation. The causes of depreciation fall into three general categories. Number 1, physical deterioration, which is curable or incurable. Number 2, functional obsolescence, which is curable or incurable. And number 3, external or economic obsolescence. Physical deterioration and functional obsolescence are inherent in a property itself, whereas external obsolescence is extrinsic to the value to the property, that is, caused by forces outside the property. In addition, external obsolescence is often termed economic or locational obsolescence, although the term currently used in appraisal is external obsolescence. Physical deterioration and functional obsolescence are further categorized as curable or incurable, depending on whether the value added by curing them exceeds the cost of cure. The term incurable applied to depreciation has the sense that it is not economically prudent to cure the condition, rather than its common meaning of being impossible to cure. External obsolescence is seldom classified as curable. Ways of measuring depreciation are discussed later in this chapter. Physical deterioration. Physical deterioration represents a loss in value attributable to normal wear and tear in service and the disintegration of an improvement from the forces of nature, the physical wearing out of the improvement. The physical deterioration of an improvement is inevitable and begins immediately following the completion or installation of a building component. Man-made objects begin a slow process of deterioration as soon as they are created, simply because of the passage of time. Decay may be due to a normal chemical change in a material's composition or may result from mechanical causes. Proper maintenance of an improvement typically slows this process of physical deterioration. However, deterioration cannot be avoided. Among the most common causes of physical deterioration are wear and tear through use, breakage, negligent care, infestation of termites, dry rot, moisture, and the elements. Items of physical deterioration are considered curable if the cost to cure is less than the resulting increase in value. The most common example is a single-family residence called a fixer-upper. It is usually described as structurally sound, but in need of cleaning, minor repairs, and new paint to bring its appeal and appearance up to the standard of the other single-family residences in its neighborhood. The end result is typically a corresponding increase in value, which is defined as a curable physical deterioration. Incurable physical deterioration items are those for which the cost to cure is greater than the resulting increase in value, or those not economically feasible to cure on the date of appraisal. The test of whether an item is curable or incurable is measured on the effective date of appraisal. Functional obsolescence. Functional utility is the overall usefulness and desirability of a property. The ultimate criterion is whether the improvement efficiently satisfies the wants and needs of the market. Functional obsolescence is the loss of value in a property improvement due to changes in style, taste, technology, needs, demands, and can be curable or incurable. Functional obsolescence exists when a property suffers from poor or inappropriate architecture, lack of modern equipment, wasteful floor plans, inappropriate room sizes, inadequate heating or cooling capacity, and so on. It is the inability of a structure to perform adequately the function for which it is currently used. External obsolescence. External obsolescence is the loss in value as a result of the impairment in utility and desirability caused by factors external to the property, outside the property's boundaries, and is generally deemed to be incurable. External obsolescence can be caused by a variety of factors, such as changes in the highest and best use of a property due to market shifts or governmental actions, tariffs, regulated rate of return, restrictions on income, zoning, neighborhood decline, lack of property demand, and national economic conditions, war, oil prices, and interest rates. External factors frequently affect both land and improvement components of a property's value. Often external obsolescence can be allocated between land and improvements. This is critical when external obsolescence is already reflected in the estimate of land value. Total depreciation. Theoretically, depreciation begins to accumulate as soon as the construction is finished. Even in an improvement that represents the highest and best use for the site. Even though most forms of the physical deterioration can be rectified or at least temporarily stopped, there can still be some physical deterioration to the new improvement. Also, new improvements sometimes have built-in functional obsolescence. After the appraiser discovers and identifies the various types of depreciation, the next step is the selection of a method to measure the loss in value. Methods of measuring depreciation. Estimating the value lost from depreciation is one of the most controversial aspects of the appraisal process. 5 methods are used to measure depreciation, 2 indirect and 3 direct. Each has advantages and disadvantages and a different degree of reliability. Direct methods involve measuring the depreciation of the subject property, whereas indirect methods use sales of comparable properties, market extraction, and income loss from the properties to measure depreciation. Sales comparison and indirect method and economic age, life, and direct method are the primary methods used by most appraisers to estimate the total depreciation of a property. Both methods are applied to the whole property and are easier to understand and use. The methods of measuring depreciation are categorized as follows. Indirect methods. Sales comparison, market extraction method, capitalization of income method. Direct methods. 1. Economic age life method. 2. Modified economic age life method. Breakdown method. Indirect methods of measuring depreciation. Sales comparison method, single property appraisal. The sales comparison method of estimating depreciation, also referred to as the market comparison or market extraction method, borrows from the sales comparison approach to value and is used for single property appraisal as well as mass appraisal. This method is particularly useful in mass appraisal work because it measures depreciation directly from the market, that is, by analyzing sales from which the depreciation can be extracted. The accuracy of this method depends on the availability of highly comparable sales of improved properties and vacant sites. The method requires the stratification of the sales by some common denominator. As an example, for family single residential, quality grade might be appropriate. In the sales comparison method, depreciation of the subject property is based on the amount of depreciation suffered by comparable sales in the market. Recently sold properties having improvements of similar age, condition, and desirability to the subject are used. Total depreciation applicable to the subject's improvement by using the sales comparison method can be estimated by using the following 6 steps. Number 1. Subtract the market value of the land site from the selling price to derive the depreciated value of the improvement. Number 2. Estimate the cost new of the improvement. Number 3. Subtract the depreciated value of depreciation from the estimate of cost new to find the dollar amount of the improvement. Divide the dollar amount of the improvement by its cost new estimate to arrive at the total depreciation percentage. Divide the total depreciation percentage derived in step 4 by the age of the improvement to derive depreciation percentage on an annual basis. Number 6. Multiply the annual percentage depreciation in step 5 by the subject improvement's age to derive the total depreciation by the sales comparison or market extraction method. For example, a subject single-family residence has a cost new of $425,000, is 15 years old, and has a land value of $125,000. There are 2 highly comparable sales similar to the subject. Comparable 1 is 16 years old and recently sold for $350,000. The market value of its site is well documented at $87,500, and its cost new has been estimated at $437,500. Comparable 2 is 12 years old and recently sold for $400,000. The market value of its site is well documented at $100,000, and its cost new has been estimated at $428,600. The annual percentage depreciation for application to the subject property can be derived as shown in Table 10.1. Table 10.1. Calculation of depreciation from comparable sales. Comparable 1. Let's see.
Now it's a chart of what was read in the paragraph.
Yeah, I was just going to try and name what some of these were as we went through them. Like the $350,000 is the sale price, the recent sale price. Subtracting the $87,500 for its market value of the site,
land,
which is the land, which is equal to $262,500, which is the value of improvement. So the cost new of it is $437,500
The cost new
of
of the improvement.
the improvement. So then you take the $437,500 and subtract the $262,500 to equal the $175,000 amount of depreciation. Then you take the $175,000 depreciation amount and divide that by the cost new amount of $437,500 equals 40% total depreciation. Then you take the 40% total depreciation and divide that by 16 because it's 16 years old, and that equals the 2.5% annual depreciation rate of this comparable one property. So we'll try it again with comparable two. $400,000 is the recently sold for price, less the $100,000 of the land price, which is equal to $300,000 for the value of the improvement. So then you take the $428,600 for the cost new estimation
Of improvement.
Of the improvement, yes, I'm sorry. And so then you subtract the $300,000, which was the value of improvement, and that gives you $128,600, which is the amount of depreciation. Then you take the $128,600 and divide that by the cost new improvement amount of $428,600, which gives you 30% total depreciation. Then you take the 30% and divide that by 12 because it sold 12 years ago. No, it's 12 years old.
12 years old.
Right, I'm sorry. And that is equal to 2.5% annual depreciation rate. Then your subject improvement, it's 15 years old, and you multiply that by the 2.5% annual depreciation rate.
That we got from the comparables.
Yes, and that equals the 37.5% depreciation rate. And then you take the $425,000, which is the single family residence cost new amount that we were given. You multiply that by the 37.5%, and that equals $159,375 in total depreciation. And then you take the $425,000 minus the $159,375 equals $265,625 for the depreciated value of improvement. Then you take the $265,625 and add in the $125,000 for land value equals $390,625 of market value of the subject. That's clear as mud.
But you read it right.
Well,
that's all that matters.
Yeah. So there's an asterisk way back on the first comparable and the second comparable on the cost new of improvement. The cost new is your replacement, reproduction, original, or trended reproduction cost. Something to keep in mind. In order to estimate the total economic life expected by the market from the comparable sales in Table 10.1, the appraiser should divide 1.0 by the annual depreciation percentage, the reciprocal, and comparable 1 and comparable 2 annual depreciation was 2.5%. Simply dividing 1.0 by 2.5%, the reciprocal, yields 40, which is the total economic life expected by the market as extracted from these two sales. As shown in Table 10.1, the site value of the comparable property is deducted from its sale price to derive the depreciated value of the improvement. The depreciated improvement value is then deducted from the estimated cost new, replacement, reproduction, historical, or trended historical, of the comparable property's improvement to yield the dollar amount of the depreciation suffered by the comparable property. For this reason, the depreciation of the sale property should be converted to a percentage figure before an attempt is made to apply it to the subject property. The depreciation percentage is obtained by dividing the lump sum depreciation by the cost new to derive the total depreciation percentage. This depreciation percentage should then be divided by the age of the comparable property to compute the annual percentage rate. The annual percentage rate should be calculated from several comparable properties, so the appraiser can have a solid basis for obtaining an annual depreciation rate to apply to the subject property. The appraiser then decides on the annual depreciation percentage that is appropriate for the subject property. By revising the process in Table 10... By reversing the process in Table 10.1, the appraiser can calculate the market value of the subject property by the cost approach. Cost new of the subject property multiplied by the depreciation percentage equals the dollar amount of depreciation. The dollar amount of depreciation is then subtracted from the cost new of the subject improvement to obtain the current value of the improvement. To this is added the value of the subject property's site or land to obtain a total indication of value for the subject property using the cost approach to value. The steps are as follows. Example: cost new of improvement less the total depreciation equals improvement's depreciation cost added to the site or land value and site improvements equals market value by the cost approach. Cost new is the replacement, reproduction, original, or trended reproduction cost. In valuing property, the appraiser is usually interested in determining the percent of good of the improvements. Percent good is defined as the percentage of improvement value remaining and is the opposite of depreciation, the percentage of improvement value lost. The percent good of the improvement is found by subtracting the depreciation percentage from 100%. A more direct way of calculating percent good is demonstrated below using comparable 1 from Table 10.1. The sale price was $350,000, less the land value of $87,500. Giving an improvement value of $262,500. So the estimated cost new of the comparable improvement is $437,500. And the percent good is equal to $262,500 divided by $437,500, which is equal to 0.60 or 60%. Percent good. So again, the cost new is equal to replacement, reproduction, original, or trended reproduction cost. The sales comparison method has a number of disadvantages. It does not allocate depreciation among physical deterioration, functional obsolescence, and external obsolescence. The method requires sales data for very comparable properties. If the appraiser has to make many adjustments to the sales prices of the comparables, the reliability of the method is adversely affected. In addition, accurate estimates of cost new and site values are required for each comparable. The sales comparison method has two primary advantages. First, when there are plenty of sales, it is probably the most reliable method because it has market justification. Second, it is a relatively fast method. Because the appraiser must value the comparable properties as well as the subject property, determining cost new and site values for each comparable property is usually accomplished without adding to the workload.